Welcome back to the deep dive. Today we are taking a scalpel to one of the most structurally fascinating and I think potentially volatile public companies in global sports and entertainment. That would be TKO Group Holdings, Inc.
Right.
And our mission today is built directly from your extensive source material. We're talking financial reports, legal filings, and some really deep analyst notes to cut through all the noise and really figure out the core investment tension here.
And that tension, especially if you're a critical investor, it's acute. It's really sharp.
How so?
Well, on one hand, TKO is defined by this deep, generational competitive advantage. It's a content platform with just unrivaled IP and scarcity.
A trophy asset, as some would call it.
Exactly, a premium trophy asset. But then on the other hand, you see these significant structural overhangs. You've got pervasive corporate governance issues, all tied back to its controlling shareholder.
And the big one.
And the looming, almost existential shadow of antitrust litigation.
So we have to answer the question, really, is the premium valuation we see justified by this incredibly wide economic moat, or is the complexity, the governance structure, the legal risk, is all of that masking a fundamental vulnerability?
Right. Is he creating what you might call a conglomerate discount relative to what its pure play potential could be?
This isn't just a deep dive into fighting and wrestling. It's really about the limits of unregulated market dominance.
It is. It's about the mechanics of high-stakes media rights arbitrage. And maybe most importantly, what happens when the legal system finally challenges the very foundation of an entire industry's labor economics.
Okay, so to frame this for you, let's start with a quick definition of this beast of a company.
Good idea. So TKO Group Holdings was born in late 2023. It came from the merger of the Ultimate Fighting Championship, the UFC and World Wrestling Entertainment, WWE.
But it didn't stop there.
No, not at all. Early in 2025, TKO expanded, I would say, aggressively by acquiring IMG, On Location, and Professional Bull Riders, or PBR.
And all of those came from its former parent company, Endeavor.
Exactly. And that move turned TKO from this high-margin dual IP holder into something very different.
A vertically integrated, diversified sports conglomerate.
That's the perfect way to put it.
And that structural change, for me, is the key pivot point in this whole story. We're now dealing with a company that's trying to control the essential content, the fights, the shows, and at the same time, control the high-margin stuff around it.
Like live hospitality, event management.
All through those assets, like On Location.
Precisely. So we need to unpack the sources to figure out, was that acquisition smart diversification? Or was it just a transaction that primarily benefited the controlling shareholder at the expense of TKO's purity?
Okay, so our analysis will flow from the strength of the assets themselves, then to the structural risks, and we'll wrap up with a valuation assessment that tries to price this binary legal outcome.
Sounds good. Let's start then with the structural advantages, the durable moat and that unprecedented monopsony power.
Okay, let's unpack TKO's competitive foundation. The first thing that really distinguishes TKO, and I think it's crucial, is that they don't just participate in a sport.
No.
They define the terms of the sport itself. This is a massive distinction from, say, the NFL or the NBA.
It's the absolute central pillar of the investment thesis. I mean, if you look at traditional leagues in North America, they all operate under a franchise model.
Right. The teams are owned by different people.
Exactly. The teams are independently owned, and the league's power is always subject to negotiation with a collective bargaining unit, with a players' union. TKO, on the other hand, fully owns and operates the UFC and the WWE.
So it's centralized.
Completely centralized. And that means they dictate the rules, they control the scheduling, and, this is the most important part, they have unilateral decision-making power over talent contracts and labor terms.
They have an operational agility and a pricing power that a franchised, unionized league it can't even dream of matching.
It's not even in the same universe.
And if you were looking for pure, unadulterated market power, you really don't have to look much further than the UFC segment. It is a masterclass in the economic concept of a monopsony.
It is the textbook example. I mean, the sources we have show the UFC controls something like 90% of the mixed martial arts industry's revenue pool.
90%.
And, crucially, it's the destination for virtually all top-tier global talent. This level of market dominance isn't just a commercial advantage. It is a structural mechanism.
A mechanism that lets them do what?
It lets them dictate labor costs, which are the primary variable expense in this entire business.
And this is where the financial numbers become, frankly, staggering. The source material highlights the historical labor costs for UFC fighters. They've consistently hovered in this very, very narrow band.
Between just 16% and 20% of segment revenue.
16 to 20%.
Now compare that. Compare that 16% to 20% against the labor share in the unionized major sports leagues.
The NFL, the NBA, MLB.
Right. The players in those leagues, through very powerful collective bargaining agreements, they typically command around 50% of the league's revenue.
50. So you're talking about a 30 to 35 percentage point difference.
That delta, that is the structural inefficiency that TKO captures. It's the core financial engine of the company, and it's exactly why the UFC segment consistently reports these industry-leading EBITDA margins that are always exceeding 50%.
So as a critical investor, you have to be asking, how on earth is this sustainable? Why hasn't this incredible financial asymmetry led to a viable competitor just popping up to pay the talent what they're worth and destabilize the whole thing?
That is the key question, isn't it? And the answer, really, it lies in what the sources call the prestige gap. It's TKO's psychological moat.
Psychological moat.
Yeah. The UFC has spent 3 decades establishing its championship belt as the sole globally recognized marker of being the best in the world.
So even if other promotions exist,
They do. Competitors exist. One championship, the new consolidated PFL after the Bellator acquisition, and they often do offer higher purses for specific fighters. But the psychological pull, the gravity, it all remains with the UFC.
so fighters are prioritizing their legacy and maybe the long-term lucrative endorsement opportunities that really only come with that global recognition of being a UFC champion.
That's it. Even if it means accepting a lower share of the promotion's revenue in the short term. The ability to dictate terms is rooted in the perceived value of the UFC brand itself.
It's a high barrier to entry that isn't financial. It's cultural. It's psychological.
Exactly.
It is.
If a fighter leaves the UFC and, say, wins the PFL belt, the market, the fans, everyone still views the UFC champion as the true global standard.
Yeah.
And that intangible prestige creates this enduring talent lock-in that, traditional economic theory would suggest should be impossible.
Okay, let's pivot to the WWE side of the business. The IP lock-in there is different. It's not about this raw market power over a pool of talent.
No, it's not.
It's about theatrical intellectual property rights and just this massive brand heritage.
The WWE brand heritage is multi-generational. I mean, it reaches over 1 billion households globally. And the fan base displays really high switching costs.
Because the product is serialized.
Exactly. It's like a soap opera. If you stop watching Monday Night Raw or SmackDown, you just lose the narrative thread. That ensures really high fan retention. But the crucial lock-in for the talent is it's legal and contractual.
Explain that mechanism for us.
Well, WWE maintains explicit, ironclad IP ownership over the characters, the names, the gimmicks, everything created within their universe.
So the performers don't own their own personas?
Not at all. The source material mentions the specific example that when a wrestler decides to leave, they generally cannot take their established, valuable brand equity with them.
So The Rock couldn't just leave and be The Rock somewhere else?
Not without a specific and I'm sure very costly negotiation with the company. This means the talent's most valuable asset, their stage identity, is owned by TKO, not the performer.
That creates a powerful contractual barrier to exit. It ensures that established talent either stays put or if they do leave, they have to completely rebuild their brand from scratch.
It's a huge risk for them.
So, okay, we've got 2 deeply protected, very high margin IP streams. Now we have to examine the economics of actually combining them. What are the synergies that justify the $9.3 billion in goodwill created by the merger?
Yeah, a massive number. The sources outline this TKO takeover model as the primary operational synergy.
The takeover model.
Right. By leveraging that combined global fan base of over 1 billion people, TKO can go to governments, municipalities in places like Saudi Arabia, Australia, the UK, and they can extract significant site fees.
And they maximize this by scheduling both a UFC pay-per-view and a major WWE event in the same city over a single weekend.
You've got it. Which means the host city gets a guaranteed massive concentrated influx of high-spending tourism revenue.
From 2 distinct but, I guess, synergistic global fan bases.
Right. So TKO maximizes the site fee they can pull because they're guaranteeing this colossal economic impact. And at the same time, they're reducing their own logistical overhead by coordinating travel and production in one single hub.
And that scale has to translate directly into sponsorship revenue, too.
Oh, absolutely. Consolidated sales teams can now package these cross-portfolio sponsorship deals. TKO becomes a one-stop shop for global brands that are seeking mass reach across two distinct, highly engaged, and relatively young demographics.
And this isn't just theory, right? The Q3 2025 numbers back this up.
Materially, the growth was driven by the synergy. UFC sponsorship revenue was up 28% year over year, and WWE sponsorship was up 20%. It's working.
Let's circle back to those margins again, but specifically how the merger accounting affects how an experienced investor should read the financials. We have these phenomenal Q3 2025 adjusted EBITDA margins.
51% for UFC, 52% for WWE.
Just incredible. But the return on equity is artificially low, sitting around 7.8%. So why should we, as critical investors, basically filter out that ROE number?
This is so crucial for a sophisticated investor to understand. The legacy UFC business is intrinsically asset-light. It generates extremely high returns on tangible capital employed. They don't own the arenas, they don't own the stadiums.
Right.
But the merger created an enormous amount of accounting goodwill, that $9.3 billion figure you mentioned. And that goodwill represents the premium paid above the tangible book value of the companies they acquired.
And that goodwill then has to be amortized, which is a non-cash accounting charge.
Exactly. So amortizing that massive $9.3 billion of goodwill creates this huge drag on the reported GAAP net income. And therefore, it artificially suppresses the reported return on equity down to that 7.8% figure.
So it's accounting noise.
It's pure accounting noise.
Yeah.
The critical investor has to filter that out. You have to focus on the underlying asset quality, that high margin profile, the high return on tangible invested capital, to get a true sense of the cash generation efficiency. The current ROE is just a snapshot of merger accounting. It is not a reflection of operational quality.
That's a key distinction. Now, let's zoom in on the UFC's unit economics for a second. The sources indicate that back in 2024, the UFC generated about $220.4 million in revenue across roughly 42 events.
Which averages out to approximately $5.2 million per event.
And that $5.2 million average, that's the evidence of their high operating leverage, right?
That's it, because the majority of the cost structure, the content creation, the fighter pay, at that 16-20% level, the general production crew, it's either fixed or it only increases incrementally.
To any additional revenue.
From site fees, international media rights, news sponsorship, almost all of it flows directly to the bottom line. It makes the business extremely efficient at converting revenue into profit. And that really sets the stage for the massive shift we're about to talk about.
The pivot toward those highly stable, high-value rights deals.
Trading volatility for visibility.
This shift is, I think, maybe the most transformative element for TKO's long-term valuation stability. They are consciously de-risking the entire business model.
Completely. They're moving away from that transactional revenue, the unpredictable event-by-event risk of pay-per-view, and they're embracing these massive, long-term, guaranteed annual rights fees from the big streaming platforms.
And this whole trend is just validation for TKO's content as a true premium asset.
It is. Live sports, or in this case sports entertainment, has cemented its position as the critical churn reduction tool for SVOD platforms all over the world.
So Netflix, Paramount Plus, they're not just looking for the next binge-worthy drama anymore.
No, they need sticky appointment viewing. They need something that justifies that monthly subscription fee, especially in markets where subscription fatigue is really starting to set in. TKO provides exactly that.
Let's start with the WWE side of it. They struck the earliest and I think maybe the most symbolic deal of this new era, the Netflix arrangement.
A monumental deal.
Yeah.
A 10-year, $5 billion deal for their flagship show, Monday Night Raw, starting in January of 2025.
And that achieves several vital things for TKO.
3, really. First, it gives them guaranteed high-quality revenue visibility over a full decade. That insulates TKO from the constant decline of the linear cable ecosystem.
Which is a dying business.
It is. Second, it immediately secures them global distribution via the world's largest streaming platform. And third, it just immediately raises the revenue floor for that entire WWE segment.
And the early 2025 data we have, it suggests this is a very smart tactical trade, didn't it?
It did. I mean, there was some initial concern about whether the viewership would translate from cable to streaming. But the data shows that Raw's viewership on Netflix has stabilized at levels that are comparable to what they were getting on cable.
Around 1.8 million U.S. viewers.
Right. But the qualitative win here is huge. Engagement is significantly higher among those key younger demographics, and in international markets that WWE previously struggled to monetize effectively through all these fragmented network partnerships.
So it's a huge boost to their distribution efficiency and their demographic reach.
Enormous.
And then the UFC followed up with an equally decisive move, the massive Paramount deal, which is set to kick off in 2026.
That deal just fundamentally restructures the UFC's domestic monetization. It's a 7-year, $7.7 billion agreement with Paramount, which of course includes CBS and the Paramount Plus streaming service.
Which gives them an average annual value, an AAV, of $1.1 billion.
Which is effectively double the value of the previous ESPN deal. It's a massive step up.
But the biggest structural consequence here is what this deal effectively ends.
Yes, it ends the traditional domestic U.S. pay-per-view model. It's gone. All major UFC events will now be moved behind the Paramount Plus subscription wall.
And that's the core trade-off.
It is. TKO is sacrificing the high upside volatility of those blockbuster PPV events, the kind that would just spike when a massive star like Conor McGregor was fighting for a substantially higher, predictable, and guaranteed annual payout.
So TKO is effectively just transferring the risk of content monetization straight to the distributor.
100%. Paramount is taking on the risk of subscriber acquisition and retention based on the quality of the fight card, while TKO receives the same $1.1 billion AAV whether the event features a megastar or just a preliminary fight.
That financial certainty is just profoundly de-risking for TKO's entire cash flow profile.
Absolutely. And the market rewards that kind of stability with a higher multiple. But let's connect this back to the labor economics we talked about earlier.
Right.
The end of domestic PPV has immediate and I think very complex implications for how the top-tier fighters are compensated.
Because historically, the elite fighters got PPV points, a percentage cut of the revenue generated above a certain buy threshold. It incentivized them to promote the event.
Right. And with the elimination of domestic PPV, that mechanism is now functionally obsolete.
Which gives TKO a lot more contractual leverage going forward.
Significant leverage. While management has publicly said that bonuses will increase, they also made it clear that star incentives will now be tied to new, and I would stress, highly opaque metrics.
Things like viewership figures on Paramount Plus or direct subscriber acquisition numbers.
Things like that, yes. Things the fighter can't easily audit or verify.
So if the metrics are proprietary, opaque, or just subjective, the negotiating power fundamentally shifts away from the athlete and back toward the promoter, TKO.
That's the investor interpretation you have to adopt. The end result is a predictable, high-quality growth floor for TKO, secured through the late 2020s by those embedded annual escalators in both the Netflix and Paramount deals. That visibility is a premium commodity in today's media market.
Okay, so using this new secured cash flow base, TKO moved very aggressively to diversify and launch new ventures. The sources detail the, let's call it, controversial acquisition of assets from Endeavor in early 2025.
Right. The acquisition of IMG, On Location, and PBR for $3.25 billion in an all-stock deal. Management frowned it as strategic consolidation to create a vertical experience company.
Now, the timing of it.
The timing immediately raised critical governance flags.
Because it happened just as Endeavor, TKO's majority owner and the entity controlled by Silver Lake was preparing to go private.
Precisely. Analysts were highly skeptical that TKO, the high-margin public company, was acquiring these assets purely for strategic reasons. The critique was that TKO potentially overpaid.
Especially for assets like On Location.
Yes, which operates at notably low 6% margins. The transaction, therefore, looks suspiciously like it was serving Endeavor's immediate liquidity and strategic goal, which was to offload lower-margin assets and streamline its portfolio ahead of privatization.
Rather than maximizing shareholder value for TKO's minority owner.
That's the concern.
Hold on, let's be clear here. If your core business is operating at 50% plus margins, and you go out and acquire assets operating at 6% margins, as On Location does, that is a massive quality impairment for the overall business.
It is.
So is there any evidence that this diversification actually protects the business, or was this purely a bailout for the parent company?
I think the sources suggest the motive was mixed, but the financial impact is unequivocal dilution. TKO is structurally shifting from a pure-play IP holder, which commands the highest multiples, to a sports services conglomerate.
And we can see the impact immediately in the Q3 2025 margins.
Immediately. The acquired IMG business operates at an 18% margin. And while that's better than On Location, it's vastly inferior to the UFC and WWE core.
So the price TKO paid for diversification was a significant dampening of its overall earnings quality. The conglomerate discount really starts right there. High-quality core earnings are now being mixed with lower-margin services revenue.
which inevitably drags down the consolidated valuation multiple. The investor has to analyze this as a governance tax.
A governance tax.
Yeah. The question isn't whether On Location could be synergistic long-term. The question is whether TKO, given its controlled board structure, paid a fair price for the asset, or if the transaction primarily benefited Silver Lake's timeline for taking the parent company private.
And that conflict of interest is the very definition of a governance risk. Now, beyond securing the core and dealing with this corporate restructuring, TKO is using its cash flow stability to make a big asymmetric bet: Zuffa Boxing.
Yes, this is fascinating. TKO is launching Zuffa Boxing in 2026. And the aim is to apply the exact same centralized, dominant promotion model, the monopsony model, to the notoriously fragmented, boxer-driven sport of boxing.
A huge strategic play.
Massive.
Yeah.
And it's backed by the Saudi Public Investment Fund, the PIF, via Sella. And it already has a media rights deal secured with Paramount. It's a direct attempt to replicate the UFC's market dominance in a much older, much more chaotic sport.
And that bet is significant because management clearly sees the global sports rights market growing dramatically. They estimate it'll be up to $79 billion by 2028.
And their whole international strategy, including that aggressive site fee extraction in places like Saudi Arabia, Australia, and the UK, is central to maximizing that growth.
But this brings us squarely to the existential threat that is hanging over the high-margin core of the business.
The antitrust litigation.
So we've established the dominance and the superior economics, but now we have to confront the primary threats that could fundamentally impair TKO's entire business model. For the critical investor, the antitrust litigation is the binary variable that dictates the stock's future.
It is, and we need to dissect the two major class action lawsuits. First, there was Levi Zuffa, which covered the period from 2010 to 2017.
And they settled that one.
They did. TKO successfully settled it in late 2024 or early 2025 for a payment of $375 million. Now, while that's a significant number, settling it removed the massive financial tail risk of a multi-billion-dollar jury verdict for that historical period.
So that was a de-risking event.
It was. But the active, ongoing structural threat is the second lawsuit, Johnson v. Zuffa, which covers 2017 to the present, and this is the one seeking injunctive relief.
That phrase, injunctive relief, is the critical difference, and it must be fully understood by any investor.
It has to be. This is not simply about paying a fine. It means the court, if it rules against TKO, could force permanent structural changes to the way the UFC operates its business.
It's challenging the core mechanisms of their monopsony.
Exactly. The restrictive championship clauses and the exclusive negotiation windows that bind fighters to the promotion for years, regardless of their actual market value.
So, if the court mandates that these restrictive clauses have to be removed, what specific structural changes could the UFC be forced to implement?
The sources outline several possibilities. The court could mandate the elimination of the reverter clause, which allows the UFC to perpetually renew contracts if a fighter holds a title.
Wow.
It could force the end of the exclusive matching period, preventing TKO from keeping fighters locked up while they shop for competitive offers. And in the worst-case scenario, the court could impose structural separations.
Like what?
Perhaps requiring the UFC to separate its promoter function from its management function, or even mandating collective bargaining, which would fundamentally alter the independent contractor status of the fighters.
If that structural mandate happens, if the UFC is forced to compete for talent in a true free market, what is the immediate financial consequence? We need to quantify this risk.
The impact would be catastrophic to the investment thesis. The market structure would shift from a monopsony one buyer dictating price to an oligopsony or even a competitive market where the talent gains all the negotiating power.
And labor costs would
Skyrocket. They would skyrocket. We noted before that the UFC maintains those 50% plus margins by paying fighters 16–20% of revenue. If the court forces TKO to pay fighters in line with other major U.S. sports, let's say 30–35% of segment revenue, that margin compression is devastating.
Let's put some numbers on that hypothetical collapse. Analysts are projecting TKO's EBITDA to expand to around $2.2 billion by 2028. If the UFC segment, which is a huge part of that projection, suddenly faces a 15 to 20 percentage point drop in its margin because of increased labor costs.
That $2.2 billion EBITDA projection could instantly fall by hundreds of millions. It might be closer to $1.5 billion.
Or even less.
Or even less, exactly. The current valuation multiples are pricing in the sustainability of that 50% margin. If that margin profile is structurally impaired, the stock multiple will collapse immediately
The market will stop valuing TKO as a premium IP platform.
and start valuing it as a heavily regulated, lower-margin entertainment promoter.
Which would compress the multiple from the current 2025x down to, what, 1215x?
Or lower. This is the binary downside risk the critical investor absolutely must fully model.
And overshadowing all of this is the perennial sort of dormant threat of fighter reclassification.
The reclassification risk treating fighters as employees instead of independent contractors, that is a potent regulatory stick.
And what would that do?
It would immediately impose massive new costs,
Right.
payroll taxes, unemployment insurance, providing benefits, and critically, it would facilitate collective bargaining. TKO's high free cash flow conversion is reliant on its asset-light, independent contractor unit economics.
So losing that status would fundamentally alter the economics of every single fight card.
Completely change the business.
Let's shift back to that governance tax, which really stems from the relationship with Endeavor and Silver Lake. Endeavor still owns about 59% of TKO. They still control the board. And while executives like Ari Emanuel are compensated heavily in equity, the structure itself just breeds these conflicts of interest.
The control dynamic is the structural issue. The board is controlled by the majority shareholder, which can, and as we've seen, did lead to transactions that prioritize the parent's interest over TKO's minority shareholders.
And that $3.25 billion asset transfer in 2025 is the primary evidence analysts keep citing.
It is.
Walk us through the specific critique of that transaction one more time.
Okay, so when Silver Lake decided to take Endeavor private, they wanted to streamline the parent company's assets. TKO, as the high multiple public vehicle, was the liquidity target,
The piggy bank.
the piggy bank. By forcing TKO to acquire lower margin assets like On Location with its 6% margins and IMG at 18% margins in an all-stock deal, TKO minority shareholders were diluted.
And the company's overall margin profile was impaired.
Right, but Endeavor received substantial value and was able to offload these less desirable assets right before its privatization.
So TKO minority shareholders paid a tax on their earnings quality and were diluted just to facilitate the strategic goals of the controlling private equity firm.
That is the direct implication. The transaction raises valid, persistent concerns about whether TKO's board truly acts independently or if it just functions as an extension of Silver Lake's private interests.
And for critical investors, this governance tax demands a valuation discount relative to truly independent companies, regardless of how good the core assets are.
It has to.
Finally, we can't ignore the reputational shadow that's been cast by the lingering legal issues involving the former WWE CEO Vince McMahon.
No, you can't. And while McMahon has resigned and is systematically selling off his shares, the sex trafficking lawsuits and the ongoing Department of Justice and SEC investigations, those remain active.
And TKO has tried to financially ring-fence the fallout.
They have. TKO as a corporate entity is shielded from the personal liabilities, but the reputational shadow over the WWE brand remains. It requires ongoing monitoring, it serves as an operational distraction, and it underscores a persistent weakness in a historic corporate culture that TKO is still working to overcome.
Okay, shifting to our final section, let's analyze how TKO's strategy has impacted its financial standing. Let's talk cash flow, margins, and valuation multiples. The most immediate improvement is the quality of the revenue mix.
Absolutely. The transition from that volatile transactional PPV revenue to these highly stable recurring rights fees provides a massive improvement in revenue predictability.
The numbers bear that out.
They do. Full year 2024 revenue hit $2.804 billion. That's a massive 67% year-over-year jump, largely driven by the consolidation of a full year of WWE financials into the TKO structure. It just confirms the baseline scale of the operation.
But as we've discussed, those 2025 acquisitions immediately diluted the consolidated margin profile. We need to clearly quantify that shift from pure play margins to conglomerate margins.
The Q3 2025 segment performance data gives us the precise illustration of that margin compression.
Lay it out for us.
So the core assets remain exceptional. UFC adjusted EBITDA margin at 51%, WWE adjusted EBITDA margin at 52%. Just saucer-like numbers.
But then
the new asset base drags all that down. IMG adjusted EBITDA margin was just 18%.
So the result is that the consolidated adjusted EBITDA margin for TKO was pulled down significantly.
All the way down to 32%. This is the measurable cost of that diversification. It's the definition of a conglomerate discount. You are blending software-like earnings with services-like earnings.
But despite that margin dilution, the business remains an exceptional free cash flow generation machine. And that's thanks to its asset-light nature.
The FCF conversion is phenomenal. TKO's capital expenditures are really low. As we said, they don't own the stadiums, and their main CapEx is just maintaining their content production centers, like the Performance Institute.
And management has a target for FCF conversion.
They target FCF conversion in excess of 60% of adjusted EBITDA. But in Q3 2025, they actually blew past that. They reported FCF of $399 million, which equates to an impressive conversion rate of 111%.
Wow, how?
It was aided by some favorable working capital timing. But still, that high FCF conversion is a critical indicator of the underlying business quality and efficiency.
And this robust cash flow has allowed management to initiate a capital return program, which signals a new level of maturity and confidence in that long-term, guaranteed revenue stream.
It does. Initiating a quarterly dividend, $75 million a quarter, is a major signal to the market that the company believes its cash flows are stable and sustainable through the next decade.
And even more importantly, the buyback.
Right. They announced a $2 billion share repurchase program, and in late 2025, they executed a significant portion of this through an $800 million accelerated share repurchase, or ASR.
Why an ASR specifically? Why not just a simpler open market repurchase program?
Well, an ASR is usually preferred when management wants to return capital very quickly and efficiently, often to manage an immediate dilution event.
And in this specific scenario,
The ASR served a dual purpose. First, it returned a substantial amount of capital quickly. But critically, it also served to offset the dilution that was caused earlier that year by the all-stock acquisition of the Endeavor assets.
so it's a proactive move to clean up the cap table.
Yes, and to signal to the market that management was committed to mitigating the dilution impact from that controversial asset transfer.
Finally, let's get to valuation. TKO trades at a premium multiple relative to traditional media companies, and that has to reflect market anticipation of those massive rights fee step-ups that start in 2026.
The market is absolutely pricing in that future growth. TKO's PE ratio is high, sitting somewhere between 63 and 78x trailing earnings.
Which is typical for a growth company where current GAAP earnings are temporarily suppressed by non-cash charges.
Like that huge goodwill amortization we discussed earlier. More relevantly, the enterprise value to EBITDA multiple hovers around 20 to 25x.
Which is dramatically richer than legacy media companies like Disney or Warner Bros. Discovery.
Oh, they often trade below 10x. TKO is being valued as essential content, not as a traditional network.
But, and this is a big but, when we compare it to its closest structural peer, another highly protected, high barrier to entry global sports property, TKO trades at a noticeable discount.
That's the key arbitrage observation for an investor. TKO trades at the low end of that 20-25x range, whereas Liberty Media Formula One F1, which is a very similar scarcity asset, often trades above 25 by EBITDA.
So that differential, that 3 to 5 multiple point gap,
That is the quantifiable cost of the governance discount and the lingering existential legal risk of the Johnson v. Zuffa antitrust case.
so the intrinsic value here hinges entirely on how you underwrite that legal risk. If the legal risks go away, TKO should, theoretically, re-rate toward the FY1K multiple.
That's the binary outlook. Based on the source projections, we see a clear growth runway. Revenue is projected to hit around $6 billion by 2028, and EBITDA expanding to $2.2 billion, with consolidated margins stabilizing around 35–40% after the dilution.
So if the Johnson case is resolved favorably,
TKO could easily re-rate to 25x EBITDA, which suggests massive shareholder upside. Conversely, if that antitrust risk materializes and forces Fighter pay up to 35%, impairing that entire margin profile,
the multiple will compress rapidly.
it can fall to 12–15x due to the fundamental alteration of the business economics. That is the critical risk assessment that's required for this stock.
So what does this all mean for you, the critical investor? Our deep dive into TKO Group Holdings reveals this powerful investment trade-off. TKO possesses unparalleled market dominance in essential IP. It has successfully transformed its revenue quality by locking in massive, stable cash flows from Netflix and Paramount, and it's demonstrating capital maturity through its shareholder return program.
But juxtaposed against that strength is the non-financial risk profile. You have the constant shadow of the controlling shareholder structure, the critique that the company may have been leveraged to benefit Silver Lake.
And the big one.
And most importantly, the binary structural threat posed by the Johnson v. Zuffa antitrust litigation, which challenges the very foundation of the UFC's 50% margin profile. The entire thesis rests on the sustainability of the current labor model.
So TKO has been brilliant at insulating itself from consumer subscription fatigue. They've transferred that content risk to the massive distributors. But what you're arguing is that TKO has not insulated itself from regulatory or legal intervention.
And that is the far greater high-impact risk.
That's the correct distinction.
It is. If we answer the critical question, was the WWE Netflix deal a transformative moment, or was it a peak valuation event? The source material strongly suggests it is transformative.
How so?
It validates sports rights as the killer app for streaming retention. It secures TKO's global relevance and provides a predictable, high-quality cash floor for the next decade.
So the floor is secure.
The floor is secure. The ceiling, however, is going to be determined by the courts and by corporate governance.
Which brings us to our final provocative thought for you to mull over. TKO is aggressively betting on replicating the UFC's monopsony model in a completely new arena. They're launching Zuffa Boxing in 2026 with Saudi PIF backing.
Right. And given that the Johnson v. Zuffa case threatens to fundamentally alter the UFC's domestic labor model by challenging all those restrictive clauses, is this aggressive push into Zuffa Boxing, with its international focus and state-backed financing, is that the ultimate hedge against U.S. domestic regulatory change?
Interesting.
TKO may be creating a new, globally focused vehicle for their centralized promotion model, intentionally designed to operate in jurisdictions that are far less susceptible to the kinds of legal and jurisdictional pressures that are currently facing the UFC. It's a fascinating strategic pivot to monitor as these legal battles proceed.